Hello, I'm Valerie Crabtree, Instructor Coordinator and a Senior Instructor at IFREC Real Estate Schools. Thank you for joining us today for our presentation about calculating after-tax cash flow. You may want to refer to the presentation that we've done on the income capitalization approach. In that video, we've talked about calculating NOI, and that is where we start off from here. So when we have NOI, net operating income, we are subtracting from that something called ADS, and that stands for annual debt service. Let me give you some synonyms: annual principal and interest payment and annual mortgage payment. So when you see annual principal and interest payments, annual mortgage payments, or annual debt service, because you service your debt when you pay it, then you're looking at ADS. Now, ADS is never an operating expense. However, if you want to stay in your property, the lender's going to make you pay it. So it is a bill that we need to pay. So as you will recall, we subtracted operating expenses to get to NOI. And then from NOI, we subtract ADS, and that gives us something called before-tax cash flow. Before-tax cash flow is also known as cash throw-off. It is literally how much cash the investment is throwing off that we have. Now, right when we get to NOI, we take a deviation, and that deviation then takes us into another completely different column. And on that NOI column, we're going to add back something, and that is reserves. In our other program on the income capitalization approach, we talked about reserves for replacement being counted as an expense, but it's not actually an expense. It's actually a savings account. You know, you can't really tell the IRS, hey, you can't tax me on that because it's in my savings account. I wouldn't try that if I were you. So we have to add back in reserve for replacement to our NOI. So NOI plus reserves is going to give us something called adjusted NOI. However, you may see that sometimes, instead of it saying adjusted NOI, they will go to the next thing that is going to be subtracted, and that is going to be amortized loan costs. So you would have NOI plus your reserve for replacement minus your amortized loan costs. Now, there are some other things that are subtracted also, and that is the interest on the loan. Now think about this for a second. Annual debt service is your principal and interest payment for the year. Here, we're just subtracting the annual interest. Why? Because that is what you can deduct on your taxes for investment property that is going to be used in a trade or business or that is used for investment. So therefore, we want to be sure that we have subtracted the annual interest. We are also going to subtract the annual depreciation. And we are going to have another presentation that is going to be talking about how we go about calculating what the depreciation is that we are going to be subtracting each year. Keep in mind that this pro forma, or this reconstructed operating statement, is done for 1 year. Fact is, there's a name for it. It's called the broker's method because it doesn't take into account the time value of money. So we're going to see what the depreciation deduction would be for 1 year. Then we have taxable income. And the taxable income is just what it sounds like. It is what you're going to apply your marginal tax rate to. And the investor's marginal tax rate is applied to the taxable income, and that is going to give tax liability. Theoretically, it could be a tax savings, but we know realistically it is very likely a tax liability. Now, if you'll recall back in our original column that started with PGI, where we left at NOI to go and do this other calculation, now it's time to return back to that original column. And where we return is right after before tax cash flow. And from before tax cash flow, we are going to subtract our tax liability. And that will give us after-tax cash flow. And really, that is what the investor is going to be focused on, in addition to several other factors and several other ratios which the investor uses to determine whether or not they want to go through with that purchase. Thank you very much for watching.